Hello, everyone. We are now going to start the webinar. We were just waiting for some of the last attendees to join. So welcome from here in the UK, where I'm now based. And good afternoon, good evening, wherever you are as well. And welcome to today's webinar, where I will be talking about what's in store for 2024 in terms of investing. Now, it is March, but I've wanted to leave it to about this time just to really see how the year is starting to pan out, and I think we've got a good idea now. So I've got some obviously data relevant to how things are progressing in 2024. So I do hope you enjoy this webinar. Do feel free to ask any questions along the way, and of course I can follow up on an individual basis after the webinar. So Caleb, first slide, please. All right, so a little bit of background to myself, first of all, and then IP Global. So I've been in the business since it was set up in 2006, over 18 years now, predominantly across Singapore and Hong Kong. And now I'm based out of the UK, and I trip into Asia to see clients in Singapore and Hong Kong during the course of the year. So if you'd like to see me on one of those trips, again, do feel free to reach out. IP Global is a very established property investment company. We have transacted on over $3 billion of property. We've sold over 6,000 properties. We've invested across 45 global markets. So we truly have some length and breadth experience of property investing. Our business model is very unique. We underwrite. What does that mean? We commit capital to get better pricing. We're effectively taking risk. Whatever we don't sell by completion, we have to buy. Clients like the fact we've got skin in the game. It's a very unique model. We're not just purely marketing property. And in terms of transparency, we are very realistic in our data, and we can substantiate all our data. So if you look at, for example, rental projections, typically we outperform them when we come to completion. As it shares on the screen, typically rents are 105% of what is actually anticipated at outset. Now that's relevant because we do see a lot of data out there which we see as questionable, enticing to investors, but actually not realistic. We are very realistic. You know, it's our own team, it's our own rental team that are doing the rentals for us. You know, we deliver. So it is very much a research-driven end-to-end business model we operate. As I mentioned there, we do underwriting, we commit capital. So we're going to do tremendous research and due diligence on developers. And then we help the client every step of the way. We introduce them to the lawyer. We help find the mortgage. We help with the rentals with our own team, managing the whole process. And then one day we can help sell the investment too. Next slide, please, Caleb. All right, so a little bit of background to where we've invested. As you can see there, we've been active across the globe. We've done 19 projects in the US, over 150 million USD of investment. Across Australia and Asia, 51 projects. And our main markets at the moment are across the UK and Europe. The European zone, where we've done 42 projects, over 200 million US dollars of property investment right now. And here in the UK, 1.8 billion pounds of investment across 115 projects. So we have tremendous experience across many markets. And of course, most relevant to the markets we're investing in at the moment, in the UK and in the Eurozone. Next slide, please, Caleb. So let's just have a reflection on last year. So complete prime residential, that's our lettings of management business. 500 tenancies arranged across our portfolio, 99% occupancy. We talk about the importance of the rental market. In the places we invest, we are predominantly focused on city centre type investments, because clients who buy, they will have a mortgage, they want that debt service, they can be very confident of getting tenants, and we can substantiate that in our data. Interestingly, average tenancy terms are on the up. Typically, they started from a year, now it's about 1.4. years, 14 months. And in terms of rents, if we look at the last year or so, we've seen very healthy rents, around about a 9% rental increase. Next slide, please, Caleb. So what are we going to talk about today? Well, if you look at this information I put up on the screen, it's actually relevant for all markets. And so there's going to be some overlap here. But I'm going to be talking about decreasing inflation and interest rates in the UK. I'm going to be talking about German property and undersupply and Portuguese housing market views. And actually, all these kind of stats kind of overlap on each market, as you'll see as I go through the presentation. And if you look at where we are this year as to where we were last year, it's a very different outlook. If we go back 12 months, we were in the midst of interest rate rises. We were on an upward curve of interest rate rises. We didn't know when they were going to stop. Now we clearly know they've stopped, and we're all talking about rates going down. So from a property investor perspective, we can be confident that when you're looking to invest, your actual outgoings will be going down. But as I'll share with you, when we look at our markets, there is very strong undersupply in key markets, particularly because rates have gone up in recent times. So what that means is the rental market, your income, is looking to continually increase, albeit not at the pace it was last year. And then finally, I'm going to talk about the Greece Golden Visa opportunity. So something slightly different, but where we see tremendous interest in terms of the migration opportunity to achieve another passport, but obviously linked to very good underlying investment. And then at the end of the presentation, there'll be a chance for some questions. Typically, the webinar throws up a lot of questions. So if I don't answer it today, I will indeed come back to you. Okay, next slide, please, Caleb. So let's start with the UK, where I'm based. And then, yes, Caleb, if you go into the next slide, please. So let's have a look at the UK here. And I think if we just take a step back from this, obviously there's been fluctuating information in terms of when interest rates may be cut. It's kind of gone from later this year, back to June, back to later this year. Now it's kind of possibly earlier than expected. But what we saw at the start of the year here in the UK was actually a whole bunch of mortgage lenders starting to reduce their mortgages, pricing in lower mortgages for this year, actually ahead of Bank of England rate cuts. What that's actually done is it's actually fed some confidence into the UK property market. And what we've seen already in some surveys that were produced around about the end of February is that it's having a very positive effect on the market. We've seen one survey from Nationwide talking about a 0.9% increase in prices at the end of February. And we've seen property transactions, property inquiries start to be around about 15 to 20% higher than what they were last year. So the cut in actual mortgage rates on the ground in the UK has started to feed through into confidence and started to get the housing market going again. Now, just switching over to what's happening in terms of inflation, interest rates. Well, what we saw yesterday was basically a cut in inflation from sort of 4% to 3.4%. And if you look at where inflation has gone, it's gone from a peak of sort of 10, 11% less than a year ago. That was about 9, 10 months ago now. And now we're seeing it come down. And the talk is of getting it close to sort of 2% by year end. So what that means for interest rates is the trajectory is going to be cuts in interest rates, but probably not till potentially sort of June or July, just because they want it to settle down to make sure that they do know it's consistently going in that path. But clearly things are going in the right direction. Indeed, there was the Fed meeting in the US last night, and effectively the trajectory there will be rate cuts, probably at first cut around June, and then 3 cuts between then and the end of the year. And obviously, once the US has made their cut, it's likely that the Bank of England and obviously the Eurozone will follow suit. So that's where we are in terms of interest rates, inflation. So all this is very positive for the property market. Inflation coming off, feeding into interest rate cuts during the course of this year, and that will feed into confidence. And what I'm saying to people is, actually, when you get that rate cut, that first rate cut by the Bank of England, you're going to see a lot of people jump into the property market, because what you're going to see is last year's potential buyers who put off buying, and probably there was about 30% less transactions last year. Those buyers will be coming back into the market. Then you have this year's buyers. But as you'll see when I share later slides, undersupply is very, very prevalent. So I think you're going to see a bump in prices, certainly once you see the first interest rate cut. So I'm saying to people, if you get into the market at that point, effectively you'll miss that first bump, because it takes a while to secure your property, go through the process. Now's the time, if you are finding something that is hitting your investment criteria for property, well, now is the time to transact, to buy, to hold, so that you can ride that first growth wave once interest rates cuts. And then obviously we expect more to follow at the end of this year and into 2025. So that would be my main piece of advice. If you're interested in looking to invest in property, look to make that decision sooner rather than later, before actual rate cuts do come. Okay, next slide, please, Caleb. All right, so here we are in the UK, phenomenally undersupplied market. If you look here, there's a backlog of 4.3 million homes that's cumulatively built up over the last 30 years or so, where the UK has never hit this target of 300,000 homes. If you look at what's been going on, you will see there that even in this snapshot that I took out of the Financial Times recently, over the last around about 14 years or so, it's never got anywhere near the 300,000 target. Predominantly made up of new build property, but even when the government has introduced change of usage from commercial to residential, etc., that really hasn't made a significant dent in these numbers. And it's all really due to the fact that the planning rules and regulations are super slow in the UK. More and more regulation since the Grenfell fire means that planning applications are slow, undersupplied, which is quite an appropriate word, undersupplied town planning authorities, just not having the staff to process the applications. And also, if you look at, therefore, the housing stock per 1,000 inhabitants across many countries, you'll see there that the UK sits at the lowest amount of property built per 1,000 inhabitants. So all of this information, all of this data is very, very positive for the investor, because they can see that the UK is long-term structurally undersupplied. Next slide, please, Caleb. So that's a little bit about the housing market, and obviously the undersupply will impact positively on property prices going forward. So what do we see in the rental market? Well, we took some of this data only yesterday from one of the latest Zoopla reports. And actually what we've seen is rents jump 29% since January 2020. What we see across the UK is over 51% of rented homes now have rents of over £1,000 per month, which is nearly double the level from 5 years ago. Quite a staggering statistic. Now, actually, we saw about 9% jump in rents last year. Now, that's not going to be maintained. That sort of figure is not realistic to be maintained, but 5% is what is more realistically expected this year. But still, that is a healthy, sustainable amount of rental income growth. And as I shared earlier, as I say, mortgage costs likely to come down this year, rental income going up. So that's absolutely the type of dynamic that you want to see as a property investor. If you look at the data here, it's very interesting, obviously. So the Southeast and London has the most amount of property rents over £1,000. It's one of the reasons why, from an affordability perspective, we've been focusing in some of the northern cities and also actually into Scotland, because in the north and in Scotland, affordability is far better. Rents have traditionally been lower, and there's lots more potential for rental growth. So, for example, if you look at Scotland, and we've been investing in Edinburgh, we've seen rents increase around about 11.9%, so way above the actual national average. So for us, it's about finding these pockets of value that people are moving to, and where we see good affordability, which will drive rents and obviously drive prices as well. Next slide, please, Caleb. Okay, so we're going to pause there. So that's a little bit of reflection about what we've seen in the UK market so far this year, and the true optimism that we see going forward in the property market going forward here in the UK. Now we're going to flick over to Germany. And if Caleb, if you go into the next slide, please. Let's have a look at the situation in Germany in terms of the housing market and the supply levels. Well, if you go back to 1950, Germany has had an average of 400,000 homes a year built. If you look at what's happened in this snapshot since 1990, we got as high as 600,000 homes a year. And then it really sort of took a big dive as interest rates went up around the sort of 98, 2002, sort of 2006 financial crisis sort of period. And then obviously, the fact is, when interest rates started to go down post the financial crisis, the amount of property started to go up again. But then in the last few years, we've seen the pandemic, we've seen interest rates significantly go up. We've had COVID, slow planning rules enhanced. In Germany, the building regulations are super tight. Energy efficiency is key now, given the recent sort of energy crisis in Europe. And planning applications have absolutely slowed down significantly. So when I shared with you an average of 400,000 homes since 1950, if you look at last year, we had around about sort of 270,000, so a huge deficit. This year, we're talking about 225,000. So massive undersupply, a huge undersupply of property that is just building and building at the moment. And if you think about Germany, it's the heartbeat of Europe. It's in the European Union. You have obviously the freedom of movement across the European Union. Many people come to work in Germany as the biggest economy, and what they really struggle to do is find property. So that's why we are very focused on Germany and very positive on the market there. Next slide, please, Caleb. So if we look at the rental market, and we know this because we've been investing there for quite a number of years now, mainly in Berlin and Leipzig, the fastest growing city in Germany. Vacancy rates are extremely low. If you look at rents, so rents are typically higher for new builds. Obviously, they are much more energy efficient, modern, better for heating, etc. Whereas obviously the old style property, and some of that could be rent controlled, rents have typically been quite a disparity from new build property. But I think what we see again for the outlook is we will see Eurozone rates cut. From a German perspective, from a Eurozone perspective, rates are actually lower than in the UK. So Bank of England base rate 5.25, Eurozone sort of 4%. So again, we are similarly expecting Eurozone rates to be cut this year, probably about the same time, maybe slightly after the ECB cuts here in the UK, the Bank of England, sorry. So we're probably looking at round about sort of a cut of 0.25%, perhaps 0.5%, leading into 2025 with other cuts. So again, if you look at the Eurozone, it's really a case of what we saw similar to the UK last year. We saw less buying. We saw less buying in Europe, in the UK. Again, that was because buyers were keen to buy, but the interest rate outlook really sort of curtailed their interest. And as I say, we saw sales down around about 30%. But we've started to see that trend turn now because, for the reasons I mentioned, people are looking to get into the market now, position themselves in the market ahead of Bank of England rate, ECB rate cuts during the course of this year. Next slide, please, Caleb. So what's the long-term outlook for Germany? Well, interestingly, last year was a tough year. You know, actually, just like here in the UK, sales were down. The property market was a little bit sort of depressed, economically challenges. But again, we started to see that shift just in the last 3 or 4 months in real time, as more grounds for optimism with inflation cut, interest rates looking to be cut, and this strong undersupply in the market. Indeed, the challenges in Germany allowed us to do a very good investment opportunity in Leipzig at the end of last year, which we've just launched, which I'll share with you as we go further through this webinar. We managed to get some fantastic pricing at our new Parkside Leipzig project when we underwrote a deal there that we've literally just launched, probably about sort of close to 10% off the average pricing in the market. So the outlook for Germany, strong population growth, strong rental market, given the undersupply, economic stability as the heartbeat of Europe, and it's a very tax efficient market. We talk about Germany as a good market to invest. The legal structure is freehold. You hold property in Germany for 10 years, there's no capital gains tax, and you can offset your mortgage interest to your rent. So probably the most tax efficient market in the whole of Europe. Next slide, please, Caleb. Okay, so that's Germany. And again, Germany is one of our key markets for this year. We've been investing in Germany for 15 years now and truly understand the market from beginning to end, given the infrastructure that we have over there with our rental market, our ability to do the mortgaging for the investor, have the lawyers on hand and manage the whole process. Now we're going to talk about Portugal a little bit. I love this photo. For those of you who have been there, it's Porto, of course, with all the colourful buildings. It really is a wonderful city and a wonderful country, and a country that was certainly very depressed after the financial crisis and actually took many, many years to recover, but truly is recovering now and is certainly one of the strongest economies. Recently had an election, got more of a centrist government now that has definitely put it back on track after the previous more populist government. But aside from that, it's got very good fundamentals. We like the fundamentals in the economy. Ease of business is fantastic because English being widely spoken. Infrastructure is continually being improved, and the various visa schemes are bringing in a lot of talent to work and internationals who are living and investing in the major cities in Portugal. So let's get into the next slide, please, Caleb. So Portuguese overview. Well, Knight Frank recently stated that it was one of the top 6 countries in the world for foreign investment, and that's for a variety of reasons. I just mentioned, you know, English is widely spoken, so ease of business, infrastructure, you know, top notch, rule of law is good, crime is low, great effective sort of cost of living. So businesses setting up, commercial costs are pretty cheap, and it's definitely a country that has really taken the lessons from the financial crisis and put it on a very high level to attract inward investment across the globe. Now, again, the word undersupplied absolutely comes up with Portugal. You know, quite a staggering statistic. If you go back to 2012, there were 120,000 properties built in Portugal. Now, this was still when the market was very unregulated, but you know, regulation came in as a result of many of the challenges from the financial crisis. And developers now need to be very well capitalized. They need to have a whole series of licensing in place before they can build. And that really has slowed down the amount of property that's built, alongside, you know, the usual challenges we've seen post-COVID, slow planning rules, inflation, interest rates, etc. So we have seen effectively only 20,000 properties built in the whole of Portugal last year. I'll say that again, 20,000 compared to 120,000 just over 10 years ago. And then when you couple that with all of the population growth from the various visa schemes available, Golden Visa, D7, etc., in the major cities, mainly Lisbon and Porto, you can see how that population growth versus lack of supply is really positively impacting the property market in Portugal. And indeed, we know this because we had our first project complete in Porto in October of last year. And actually, the rents that we got were around about 10% higher than we expected. And we got leases not of 1 year, but actually 2 and 3 years. So what do we see in terms of pricing? Well, there was a recent survey by the University of Munich, funnily enough, in Germany, who was saying that in the major cities of Lisbon and Porto, we're talking about average price rises of 8% year on year for the next 10 years. Now, that's not being driven by locals. It's being driven by the sheer lack of supply versus all the internationals, excuse me, moving in. And good net worth individuals with good affordability buying property that is typically quite a bit cheaper from whence they came from across the globe. So a very positive outlook we see for Portugal. Next slide, please, Caleb. Okay, so actually we saw, in terms of real time, excuse me, in terms of real numbers, we saw 6.5% growth across the whole country last year and an average of 8.7% growth in 2024. Now, bear in mind that this is still with interest rates at quite elevated levels in the Eurozone, and obviously we're talking about lower rates to come. So that's a very good sort of insight into what we're planning to see with property growth over the next few years. And we have quite a staggering statistic here with regard to the fact that between 2018 and 2023, the fact that for every new house sold, for a new house built, 10 were sold. So again, this feeds into this severe undersupply that we do see in Portugal. Next slide, please, Caleb. So allied to, obviously it's in the Eurozone. If we look at how this is going to reflect in terms of sort of lending rates on the ground in Portugal. So we're talking about sort of interest rate sitting at sort of 4.5% in terms of sort of the banks and what they typically lend at. We're looking to see that sort of trend down during this year, probably around the sort of 3.5% mark, 2.75% in 2025. We can actually look to get around about a 15-year fixed rate mortgage in Portugal, around about sort of 3.9%, fractionally lower than in Germany. We're talking about sort of 4.04% in Germany for 10-year fixes. But nevertheless, actually, there's still quite good lending rates right now when you're talking about yields of circa 5%. And as I say, rents are going to be strong and stable for quite some time. but obviously interest rates are going to go down, and as we see from this graph, steadily go down over the next year to 18 months. Next slide, please, Caleb. Okay, so that's the main markets that we're focusing on this year, and you will see those common themes that I've shared across each of them in terms of the positivity around rents, interest rates, and undersupply. Now for something just slightly different, which I just want to touch on for a minute. As you're aware, we've been investing in Portugal for quite some time. We've been doing the golden visa work. There have been some changes to that, but nevertheless, still some options to invest in the golden visa in Portugal through investing in funds, investing in setting up a business, charitable donation. But we've actually added something else to our portfolio, and that is to invest in Greece for the golden visa. Why is that? Well, it's a very attractive scheme. It's a very low cost scheme, and it is a country on the up. If you think about Greece, it has similarities to Portugal. It got terribly hit during the financial crisis. It had to borrow a tremendous amount of money to keep itself going. There were several bailouts, and it really was in a mess around the 08-09 mark. However, fast forward to 2024, through good governance, through Prime Minister Kyriakou, former Harvard graduate, Goldman Sachs employee, his father was previously a prime minister. He's really got the economy back on an even keel. When you think that Greek debt was borrowing at sort of 20%, 20% interest rate for investors to invest in Greece, given the risks associated to investing there around 08-09, we're now talking about 4.5% for government debt, which was massively oversubscribed recently. So they've really got their financial house in order, and there's tremendous amounts of investment coming in from across the globe, a lot of US investment into Greece, and it truly is one of the strongest economies. So that said, it's very much on the up, but still some very good value in assets. Indeed, as it shares their number of assets in real estate under 2008 prices. So we have been doing an opportunity in Greece. If you just go on to the next slide, please, Caleb. We see a very good investment opportunity, a very good passport opportunity. So by investing 250,000 euros into Greece, you get access to the EU passport opportunity, whereby that means you can link yourself, your wife, your mother, your father, your children to one application to give you visa-free travel across the Eurozone and the ability to live and work in Greece and across the Eurozone. The benefits of Greece investing for this purpose are it's very quick, it's very cheap, and as I always say to people, the passport side is one side of it. You need to look at the underlying investment you're investing in to get this passport opportunity. That's critical. Many schemes, the actual passport opportunity may be good, but the underlying investment may be poor. And it's important to match up the two. And we've been working with an established partner here with a very good underlying investment opportunity. So if you'd like more details of that, do drop me a line after the webinar. The point I would make is, governments aren't so keen on these schemes. A number of them have closed down across Europe and across the globe. And they're looking potentially to increase the amount from 250,000 in the Greece Golden Visa scheme. So people know that there's a limited window of opportunity, and that's why we're seeing tremendous interest, because there is an urgency for investors to make decisions if they are keen to pursue this type of opportunity. And we've seen that from the investment opportunity we have this year. So again, if you're keen to learn more about this one, drop me a line and I'll be very happy to share details with you. Next slide, please, Caleb. So that's about it from me. Before we go to questions, I just want to touch on briefly what we have in terms of investment opportunities. And we've got an excellent mix here. We've got the Bailey and Langford, which are in Manchester and Sheffield, respectively, which are completed now. So if you're looking to invest straight away, take advantage of the weak pound, get very good yields up to 7%, then those are certainly options well worth looking at. If you're looking to invest in the cities of Oxford or Edinburgh, so if you look at the Stormont or the Carrick, then we have opportunities there available. Actually, we only have one unit left at Oxford, given the popularity of that project. We've never done Oxford before. The reason being is because it's so difficult to get access to stock, to get planning permission. This is a project we're building ourselves. And if you drive around Oxford, you won't see any new build. Planning applications are very restricted. They call it the NIMBY approach, not in my backyard. Very conservative location. They do not want new build necessarily, but we spent over a year getting this application into play. So when I was there recently to visit my niece who's studying at Oxford, I drove around most of the weekend, saw nothing as a new build. So that is a real good opportunity. It's a London market, above average salaries, big tech cluster. Edinburgh, as I mentioned earlier in my presentation, it's seen some of the biggest hikes in rental growth this year, 11.9% increase in rents over the last year. We've only ever done one project there. Again, very difficult market to get access to stock, but we managed to get it through our relationship with a developer we worked with 8 times before. It's a London market, but when you figure the Carrick is only 8 minutes from the city centre and you're buying a 1-bedroom from £250,000, with all the wealth in Edinburgh, I think that's an exceptional opportunity. And then if we just go slightly down to York, again, has got one of the biggest regeneration projects in the UK. It's an extremely attractive city. We're working with a developer who we've worked with previously in York, the Helmsley Group. And you know, you're buying a 1-bedroom property with parking from £190,000. Really super opportunity that. And a wonderful city. I was up there in December. Really liked that location. Tree-lined streets, 2 Russell Group universities, beautiful city, mixed with this regeneration going on, which I think is very, very positive for the city. And finally, down on the bottom there in Sonning, which is close to Reading. Reading is a big tech cluster in the UK. What you also have 10 minutes from Sonning is Twyford Station on the Crossrail, the new fast train link into London. You're into London within 20 minutes. So Sonning is a beautiful location. This is a very unique opportunity for us, where we have an existing building where we're refurbishing apartments to a very high level, and you're buying an apartment from £345,000. So that's a good selection of what we have in the UK, and we also have something in the pipe for Birmingham as well. So if we just go on to the next slide, please, Caleb. So Germany, we've been investing in Germany for over 15 years now. We've done a lot of projects in Berlin and Leipzig. The Eves Quarter project is a beautiful location between the new airport and Berlin city centre. We've captured a lot of growth in the city centre. So we're working in somewhere like Eves Quarter, which is in a city called, town called Köpenick, where we've done a project before. It's very close to the Tesla factory and all the wealthy employees there, close to the science parks, very close to the station. A really nice neighborhood where you're buying high quality apartments in a very nice neighborhood for around about €450,000 and upwards. We negotiated some excellent pricing there. You can pay up to €9,000 per square meter there, and we've secured a project for around about 6,500 square meters. And then basically we have the Boulevard and Parkside in Leipzig. Now, if we look at Leipzig, fastest growing city in Germany. As I shared with you, Germany had a little bit of a tough time last year, and the 22 Parkside project was an amazing opportunity for us to negotiate fantastic pricing with a partner we've worked with 4 times before, the Beaker Group, very good developer. They were keen to do a deal before Christmas, and we de-risked them through taking on this project. We paid on average 5,100 euros per square meter, when typically you're looking at 5,700 euros per square meter. Actually, one project close by, 6,400 euros per square meter. And also we negotiated kitchens between 10 and 15,000, depending on the unit size, free of charge. Now, you may laugh and think, well, do not kitchens come as standard? Well, actually, in Germany, they don't, because when people move in to property for rental, they typically bring their own kitchen because they stay there a long time. But all the other projects I mentioned on that comparison list, they all exclude kitchens. So we have got fantastic pricing here with a great developer in one of the best parts of Leipzig in the west, which is very green. I've been there. It's a top location, canals, startup businesses, etc. So again, if you're interested in learning more about that, do let me know. And as I say, encompassing all of this is the fact that in Germany, it's a very, very tax efficient market. You hold the property and you can look to exit paying no capital gains tax. So happy to share more on that at the appropriate time. And then finally, if we go on to the next slide, Caleb, what have we got coming up? Well, we've got a brilliant opportunity in Birmingham. Birmingham is the second largest city in the UK here. It is on the HS2 line. It's going to be 40 minutes into London. It almost makes it commutable. It's transformed itself into a dreary industrial city to one that's littered across the skyline with beautiful modern buildings and science parks. It has the Commonwealth Games recently to put it on the global stage. Goldman Sachs, all the big corporates have moved to Birmingham because of the wonderful infrastructure. And with one of the cities in Europe with one of the youngest populations of hardworking individuals under 30, a city that's clearly on the up. And we see very, very good price opportunity rising there. And we're working with a great partner, NVSM, who we've worked with twice before in the jewelry quarter. We're doing a third project with that developer. They build grade 2 listed buildings in the jewelry quarter. And literally the jewelry quarter is a short walk into the city centre. So we're going to launch a project there from £210,000. I've got many satisfied clients with that developer. And then finally, Porto. We're working hard to secure a deal there. As I mentioned, you know, great yields, very low interest rates, massively undersupplied. I was over there in October, and we are hoping to get a deal launched during Q2 from around about €250,000. Great legal structure as well. It's freehold. The difficulty is just getting deals in Portugal, which makes us want to do it even more because that's the opportunity. There's a lot of selling in the local market as well. So Porto should be coming soon. All right, so that's it from me. If we just go to the next slide, Caleb, I think that's the questions. And I see we've had a lot of questions coming through. So let me just pick out some of those. I'm conscious of everybody's time. I like to keep these to round about an hour. So for the next 10 minutes, let me just go through some questions. Okay, the first question, what implications does the shortage of homes in the UK market have for investors? Okay, well, I think the point about that is, as I say, here in the UK, you have a growing population, you have less and less property. And that undoubtedly is going to impact very positively on prices. I mean, what we've seen in recent times is about 20% less property available in the market for rents since before the pandemic. We've typically seen one property has 20 inquiries for rentals pre-pandemic. Now it's one property for 35 inquiries. So that's why we see strong and consistent rents over the next number of years. But of course, we also see undersupply in the market. I think what's interesting, I think you're going to see a slight turning of the dynamics. So you're going to see rents, rental affordability more stretched, because obviously rents can only go up so much, and they've been going up quite a bit recently. But actually, you're going to see the dynamic on people buying property changing. So with obviously interest rates being so high and affordability stretched for buying, as interest rates come down, obviously affordability gets better. And with the lack of supply, that feeds into property prices going up. So that would be my explanation for undersupply in the UK for rental and from a capital appreciation opportunity. All right, so here we go. What are the long-term benefits of holding property in Germany? Okay, very good question. I always say to people, look at Germany as a 10-year market. Why is that? Well, you can lock in great 10-year fixed rate mortgages for about 4%, so you've got certainty on what's going out. On the other side, you can be certain of consistent long-term rental with inflation proofing, building in steady rental increases. And it's, before you factor in any capital appreciation, it's that old story, route one, why invest in property? Well, you do your, in Germany's case, 65% mortgage, you put in your 35%, your tenant pays down your mortgage, you know that you have certainty of your mortgage payment each month, you know that your rent will cover your mortgage and your rent will go up consistently. So it's very strong peace of mind investing in Germany. But then, of course, you will get strong and solid capital appreciation, no question about that, because of the fact that the market is so critically undersupplied, and you have the freedom of movement with so many people moving into German cities. Indeed, when I met my colleagues in Berlin and Leipzig when I was there 18 months ago, they said, look, there's plenty of jobs here, but what we struggle to do is find rental or properties for those coming in. That's the challenge. And it's, as I say, it's a great long-term market. The buying process in Germany is very solid. It's freehold property. It's fully offsettable for mortgage interest on a month-on-month basis. And as I say, it's very much a market where you invest, you can forget about it, and it's very, very hands-off for the investor. So if you'd like more details on Germany, as I say, do let me know. Okay, we'll take a couple more questions. Let's have a look. There's a lot of questions here. Okay. Are there any specific regions or cities within each country that offer particularly attractive investment opportunities? Difficult question to answer. I think from an IP global perspective, if you look at all the markets we invest in, it's a common theme. We're looking at value spots. We're looking at what's the trends going on. Where is it cheaper to rent and buy? Where is the regeneration? Where is the new transport infrastructure? We are looking at supply versus demand. So we spend a lot of time researching areas to make sure we are investing in very much the best locations. And of course, we're investing our own money because we're underwriting these deals, we're bulk purchasing. So for us, it's all about the research. So whether it's Edinburgh, Porto, Leipzig, Berlin, the same fundamentals apply. Ultimately, then it's a case of where does the client want to commit capital to? We will share all the financials to share how much capital they need to commit, all the costs involved, whether they want to be in GBP, for example, or Euro, and obviously sharing all of the information around tax, legal process, etc., so that they can make an informed decision. Okay, let's have a look at a couple more questions here. How will declining interest rates affect real estate financing options for investors? Well, I think, as I covered earlier, I think the major point here is the fact that when we do see that first rate cut, it will be the last piece of the jigsaw in sentiment changing for the positive in terms of investing. So I think once you see the first rate cut, obviously the US, then it will probably be here in the UK and Eurozone. You're going to see a lot of investors come into the market. A lot of investors who put off buying last year mixed in with this year's buyers coming into the market, but they will be hit with this supply crunch. Quite soon, it will be a case of the fact that they will be hit by this wall of undersupply that's built up over the last few years cumulatively because of rate increases, etc., and lack of build as a result, and slow planning rules, etc. So that's likely to bump prices towards the end of this year and certainly going into 2025 when we'll see more rate cuts. So it's very much a case of, as I'm saying to people, position yourselves now, position yourselves in the market now. If you find a location, an opportunity you want to invest in, now's the time to do it so that you are positioned ahead of that first rate cut and you can ride that first wave of growth before the herds start to come in. Get in now before the herd does would be my advice to truly maximize your property investment opportunity. Okay, I think we've got time for probably one more question. So let me just have a look here. Okay, in terms of Portugal, where would you say it is best to invest? I think as I was sharing there on the presentation, very much the biggest cities are the places to invest. So of course that will be Lisbon and Porto. Why is that? Well, that's because obviously that is where you have the biggest populations. That is where you most have the critical undersupply. And that's where you've got most of the foreign investors, the internationals moving in for work, for retirement, taking advantage of the visa schemes. And of course, as I say, with that critical affordability that they have, it will impact positively on rents and prices. I mean, for example, our project in Porto that completed in October, the tenants we have, there's quite a number actually there from multinationals. They've been transferred to Porto because of the fact that their corporates are there, commercial costs are cheaper, infrastructure is good. As I say, English is widely spoken in Portugal, so ease of business is good. So it's so attractive for businesses to put their employees into Portugal. But as I say, it's not locals really that are going to drive the pricing, it's the internationals. And as I say, that University of Munich study was very, very compelling. 8% growth on average over the next 10 years. And I truly believe that, having been there at the end of last year. Okay, all right. So we're coming up to the hour mark. I like to keep it to an hour. So all that remains for me to say is thank you very much indeed for joining the webinar today. I do hope you found that interesting and insightful and informative. And what I would say to you is if there's any other further questions, if there's any further information you need, do reach out to me. I'll come back to you over email. I'll be very happy to have a one-to-one conversation. And of course, I look forward to meeting everyone in person at the appropriate time. So thank you very much indeed for joining today. Wherever you are, have a good afternoon, a good evening, and look forward to speaking to you all again very soon. Thank you very much indeed.